Hello viewers, welcome to my channel. I'm Hasham. Last video I have explained you about the retirement benefits. At the time of retirement, the employee will get different amounts from the employer. So example are pension, commutation of pension, gratuity, leave encashment, refund from Provident Fund, etc. So many amounts the employee may get from the employer. So what are the provisions regarding the Income Tax Act regarding taxing this retirement benefits? In this video, I'm going to explain you about the provisions of Income Tax Act regarding gratuity, commuted pension, leave encashment, refund from Provident Fund, etc. All the details I'm going to explain. So watch the video till the end and take a screenshot of the points which I have written on the board. Then I'll explain all the points. First of all, death cum retirement gratuity. Gratuity means the gracious payment made by the employer to the employee for the past services rendered. The employee has spent a major part of his life in serving the organization, example 25, 30 years like that. So a major part of his life is spent in the organization. So in recognizing, appreciating that this employee has served so many years, some gracious payment will be made by the employer to the employee, that is called gratuity. Now, it is paid on the eve of retirement, death or resignation. Normally, gratuity will be paid at the time of retirement, or sometimes if the death occurred before retirement, the death occurred, then it will be paid to the legal heirs. Similarly, at the time of resignation also gratuity amount will be paid. All government employees are entitled to receive gratuity on the retirement, compulsory. So for government employees, the gratuity is compulsorily paid by the employer. Whereas in case of other employees, the provision of Payment of Gratuity Act are applicable. In India, we have Payment of Gratuity Act 1972. So accordingly, this Payment of Gratuity Act will be applied to other organizations, non-government organizations. It is applicable on some organization, not applicable on other organizations. Wherever it is applicable, compulsorily it has to be paid. Where it is not applicable, it depends on the will of the employer. Now, according to this act, where the number of employees working is 10 or more, will receive gratuity from their employer on the eve of retirement. So Gratuity Act 1972 has given the provision. If in any organization the number of employees working are 10 or more, in that organization compulsorily employer must pay gratuity to employee on the eve of retirement, at the time of retirement. Now, if gratuity is received by legal heirs, when the gratuity will be received by legal heirs on the death of the employee. So when gratuity is received by legal heirs on the death of an employee, it is completely exempted from tax, whether the employee was government employee or non-government employee. So remember the rule. Gratuity received by legal heirs will be completely exempted, not taxable at all, whether employee, government employee or non-government. Gratuity paid while in service from the present employer is not allowed as exemption. It will be treated as salary income under that salary. Sometimes, very rarely, gratuity will be paid during services only, not at the time of retirement. During the service, if an employee receives the gratuity, it is 100% taxable, no exemption at all. It is taxable under the head salary for all employees, government or non-government. Gratuity received from a former employer may be given as exemption according to the provisions explained in the Act. If when gratuity is received by the former employer, then exemption will be given. To some extent, exemption is given, remaining amount is taxable. So what are the provisions regarding Income Tax Act? First of all, gratuity received on the eve of retirement, at the time of retirement. Government employees. Government employees receiving gratuity on retirement is fully exempted. First point, make it clear. In the coming problems, you must remember this. Gratuity received by government employees at the time of retirement fully exempted. Now, non-government employees. Now, two cases are there for non-government employees. The employees who are governed by Payment of Gratuity Act and those employees who are not governed by the Payment of Gratuity Act. So whenever employees are non-government employees, you have to see in the problem whether governed or not governed, right? If it is governed, if the employees are governed by Payment of Gratuity Act 1972, least of the following three amounts are exempted. Three amounts are specified by Income Tax Act. In these three, least one you have to select. That one is exempted. Remaining amount is taxable. So these three will be applied on those organizations which are governed by Payment of Gratuity Act. First one, actual amount received. Whatever actual gratuity received, that will be taken first. Second, 15 days salary into number of years of service completed or a part thereof in excess of 6 months. Remember this wording. You have to by heart the wording. Number of years of service completed or a part thereof in excess of 6 months. In excess of 6 months. For example, an employee has served for 28 years, 8 months. 28 years and 8 months. 8 months will be calculated as 1 year. Now we'll take 29 years. Suppose if a worker has worked for 28 years, 4 months. Ignore the 4 months, take it 28 only. 6 months or more than 6 months will be calculated as 1 year for number of years of service completed. Fixed amount is 20 lakh given by the Income Tax Act. Income Tax Act has given the ceiling, maximum how much can be given. 20 lakh is the maximum ceiling of exemption. So when the employee is a non-government employee and governed by Payment of Gratuity Act 1972, least of the following three will be exempted, remaining is taxable. First one, actual gratuity received. Second, 15 days salary into number of years of service completed or a part thereof in excess of 6 months. Third one, fixed to 20 lakh. Now note, salary means basic plus DA only of the retiring month. Because we need 15 days salary. So we must know what is the meaning of the term salary here. So Income Tax Act says for calculating 15 days salary, salary means basic plus DA. Irrelevant whether DA is entering or not, compulsorily we should take DA. Basic plus DA of the retiring month. So what is the salary at the time of retirement? Basic and DA. And 15 days salary is calculated as under. Once you have calculated salary, then 15 days salary is equal to salary last drawn into 15 by 26. Why we take 15 by 26? Because in a month we assume 4 Sundays are there. So 30 days are there in a month, we assume. Out of 30 days, 4 Sundays are there, excluding 4 Sundays, 26 days. So we need salary last drawn into 15 by 26. We'll get 15 days salary. So while calculating completed of your year of service, if the fraction is 6 or more than 6 months, then it is rounded off to the next year. Just now I told you. If the fraction of the year is 6 months or more than 6 months, count it as 1 year while calculating number of years of service completed. So these are the provisions regarding non-government employees governed by the Payment of Gratuity Act. Now non-government employees who are not governed by Payment of Gratuity Act. Again, Income Tax Act has given the condition list of the following three amounts. The first, actual gratuity received. Second, half month salary, average salary. Half month average salary into number of years of service completed. Then fixed amount given by Income Tax Act is 20 lakh. So if you compare these two provisions are same. The first is actual amount received, here also actual amount received, no change. Last one fixed amount 20 lakh, here also fixed amount 20 lakh. The only difference is second point. Here we are calculating 15 days salary. Here we are taking half month average salary. Don't think that 15 days salary or half month average salary is same. No, Income Tax Act has given separate provision how to calculate 15 days and how to calculate half month. Here half month average salary. There is no average salary here. Here salary last drawn. Right? So these are the three. List of these three exempted, remaining taxable. Now note, remember the note. Average salary means average monthly salary is calculated on the basis of average salary of the 10 months immediately preceding the month in which the employee retired. In whichever the month the employee retires, before that month, you have to take 10 months average salary. For example, if an employee was retired in the month of December, so leaving December, from November go back to 10 months. November, October, then September, then August, like that 10 months you calculate. Take the total of 10 months divided by 10. You will get average salary of the last 10 months. That average salary we take half month average salary. That is the new point. This point is not there here. Here salary means basic and DA of the retiring month. Here average salary means average of the last 10 months salary before retirement. Then salary means basic pay only. DA will be included if it enters for retirement benefit. If commission is payable with fixed rate on turnover, such commission will also be included. Salary meaning different. Here salary means basic and DA only of the retiring month in case of governed. In case of not governed, salary means basic salary. DA will be included if it enters for retirement benefit. Commission if it is based on fixed percentage on turnover. Then only we should take commission also. Then while calculating completed year of service, any fraction of the year should be ignored. Here what we have taken, a number of years of service completed or a part thereof in excess of 6 months. For example, if a worker has worked for 28 years, 9 months, we'll take 29 years. 28 years, 9 months. 9 months means more than 6 months. So we have calculated 1 year. We have calculated as 1 year, 29 years. But here, while calculating the, salary, number of years, while calculating the number of years, any fraction should be ignored. For example, if the worker has worked for 28 years, 11 months, 28 years, 11 months, ignore completely the 11 months. Only take 28 years. That's it. So these are the differences between employees governed by Payment of Gratuity Act and employees not governed by the Payment of Gratuity Act. Next video we are going to solve the problem on this. Over. Now I am coming to the next point. Commutation of pension. Pension is the periodical payment made by the employer to the employee after retirement. So before retirement, the employee was getting salary. After retirement, the employee will not get the salary, the employee will get pension. That is the difference. Periodical pension received is fully taxable under the head salary. Whereas lump sum pension received is called commutation of pension. So at the time of retirement, option will be given by the employer to the employee. Suppose I am the employer, you are the employee. On retirement, I have given option to you. Do you want periodical pension or commutation of pension? If you say periodical pension, monthly you will get the pension as that of salary. But if you want commuted pension, lump sum pension will be given. Later on you will not get the periodical pension. The lump sum pension received is called commutation of pension. Only a part of the periodical pension can be commuted, not 100%. The income tax rule is no employer should commute 100% of pension. Only a part, some 40%, 50%, 60% of pension will be commuted, not 100% will be commuted. So here the provision I have explained. Now the treatment of commutation of pension is as under. Government employees, commuted pension received is fully exempted from tax. Crystal clear point. For government employees, commuted pension received is completely exempted, not taxed. For non-government employees, receiving gratuity, that means if a non-government employee is receiving gratuity and receiving commuted pension, both, in that case, 1/3 of commuted value of total pension is tax-free. Limit is given. The limit is 1/3 of the total commuted pension. That means in working note, we have to calculate what is the total commuted pension at 100%. At 100%. Example, the total commuted pension at 100% comes to 9 lakh rupees. 9 lakh rupees is the total. Now 1/3 of 9 lakh, 1/3 of 9 lakh is 3 lakh. So Income Tax Act says up to 3 lakh rupees commuted pension is exempted. Remaining is tax. Suppose if an employee receives 4 lakh rupees as commuted pension, so out of 4 lakh, 3 lakh rupees exempted, 1 lakh rupees tax. This is the rule when an employee is receiving gratuity and commuted pension. Suppose if the employee is not receiving gratuity, only commuted pension, then half of the commuted value of total pension is tax free. Example, in working note we calculate what is the total 100% commuted pension. Total 100% commuted pension comes to 9 lakh rupees. So half of 9 lakh, 4,50,000. The maximum limit of commuted pension tax free is 4,50,000. Now we compare how much actual commuted pension he received. Suppose if the actual commuted pension received is 5 lakh, so 4,50,000 is exempted, remaining 50,000 is taxed. That is the provision regarding commuted pension. Now what are the steps? Step 1. Calculate commuted value of total pension for 100%. In working note, first of all calculate what is the total value of commuted pension at 100%. Then second, calculate exempted amount. How much? 1/3 or half? How much is the exempted amount you calculate? Then third step, calculate taxable amount if any. Exempted amount, total amount you have calculated. The total commuted pension 9 lakh. Exempted commuted pension is 3 lakh. Now we compare this 3 lakh with actual commuted pension. If the actual commuted pension is 2 lakh, that means nothing is taxable because the limit is 3 lakh, but you have received only 2 lakh. So nothing is taxable, completely exempted. If the pension received is 4 lakh, commuted pension received is 4 lakh, but the limit is 3 lakh, then 1 lakh rupees is taxed. These are the steps to be adopted to find out the taxable commuted pension. That's all. So here I have explained you about gratuity and I have explained you about commuted pension. In the coming problems, I am going to apply all these provisions in the problems. So just now we have completed gratuity and commuted pension. Gratuity is the amount which is received by employee at the time of retirement. For government employees, gratuity received at the time of retirement fully exempted. For non-government employees, we have to see whether governed by Payment of Gratuity Act or not governed by Payment of Gratuity Act. So we have seen the provision. Similarly, commuted pension. Commuted pension received by government employees at the time of retirement fully exempted. Whereas for non-government employees, we have to see whether receiving gratuity and not. If gratuity received and also commuted pension received, 1/3 of the total value of commuted pension is exempted. If no gratuity is received, only commuted pension is received, half of the total 100% commuted pension is exempted. That's what we have seen. Now I'm going to explain you about leave encashment, treatment of leave encashment at the time of retirement. Apart from that, we are going to discuss about refund from statutory Provident Fund and recognized Provident Fund. Last one, retrenchment compensation. So these are the topics which are to be completed on retirement benefits. After this, we have to start the problems. Take a screenshot of the points, then I'll explain all. Come on, first of all, treatment of leave salary. Employees are entitled to different types of leave according to the contract with the employer. So different types of leaves are casual leave, is there, earned leave, privileged leave, medical leave. Different names are given, different types of leave. But broadly, we have two types of leave. First, the leave which may be availed, otherwise it get elapsed. That is called casual leave. If you take the leave, it's okay. If you do not take the leave, it will get elapsed. That means the leave will not be carried forward. Nothing. So take the leave or otherwise it will get elapsed. That is called casual leave. The next second type of leave is the leave gets accumulated year after year. The employer has given the option to you. You take the leave, or if you do not take the leave will get accumulated every year. And over a period of time, it will be accumulated leave period. That accumulated leave period can be availed or can be encashed. So the accumulated leave can be availed or it may be encashed, that is earned leave or privilege leave. Second category of leave is called earned leave. The leave will get accumulated. Now in future you can avail the leave or you can encash the leave. Now encashment of leave. During the service period, if the leave is encashed by the employee while in service, then it becomes taxable to all employees, that is government and non-government. First of all, you have to remember, encashment of leave during service period, before retirement, during service period itself, encashment of leave is there. It is fully taxable, no exemption for all type of employees, government employee or non-government employee. First point. Now, government employee, encashment of leave at the time of retirement. The main provision will apply if the leave encashment is there at the time of retirement. Then government employee is fully exempted. Very simple rule. That means gratuity received by government employee at the time of retirement exempted. Commuted pension received by government employee at the time of retirement exempted. Leave encashment received by government employee at the time of retirement fully exempted. The problem is there only for non-government employees. So for non-government employees, list of the following 4 amounts is exempted. 4 items are given by Income Tax Act. The least of these 4 is exempted and remaining is taxable. What is the first one? Cash equivalent to balance of leave period, that is unavailed leave at the time of retirement, subject to a ceiling on the basis of maximum 30 days leave for every 1 year of service. Now, first of all, cash equivalent to balance of leave period. So we have to find out how many months balance is there. How many months leave period is unavailed, subject to a maximum ceiling of 30 days for every 1 year of service. In simple words, 1 month for every 1 year of service. Example, if the employee has served 30 years, so 30 years means every year 1 month. So 30 years, 30 months. So maximum ceiling is 30 months. Now availed. He has already availed 20 months. He has already availed 20 months. So 30 months is the maximum limit, 20 months is unavailed. 20 months are availed. 20 months are availed. So 10 months unavailed. So leave, encashment of leave for 10 period. 10 months average salary. We have to calculate average salary for the previous 10 months. Then actual amount received or fixed amount of 3 lakh. The least of these 4 will be exempted. Note, first calculate the qualifying leave period, which is least of the following 2 amounts. In working note, first of all, you have to find out how much is the qualifying period of leave. First, actual leave period during the service period as per contract. As per the contract between the employer and employee, how many months leave is unavailed? That we have to find out. Second, 1 month for every 1 year of service completed is ceiling period. Now we have to find out what is the ceiling period. The least of these 2 is the leave period available for encashment. Average salary means 10 months salary preceding the date of retirement, and salary includes basic pay only. DA will be included if it enters for retirement benefit, and commission if it is based on fixed percentage on turnover. Here we need 10 months average salary. So how to calculate average salary? Average salary means the average of the previous 10 months salary, and salary means basic pay only. DA will be included if it enters for retirement benefit, plus commission if it is based on fixed percentage on turnover. That's it. So these are the provisions regarding treatment of encashment of leave. Now refund from SPF and RPF, statutory provident fund and recognized provident fund. So any refund made at the time of retirement from SPF or RPF fully exempted from tax. No provision for all employees, government as well as non-government. Now retrenchment compensation. Sometimes the employee are retrenched. Then compensation has to be paid by the employer to the employee. So retrenchment compensation received by a worker at the time of retrenchment, the exemption is least of the following 3 amounts. The Income Tax Act has given three amounts. Least of these three is exempted, remaining taxable. First one, actual amount received. Second, amount calculated as per the Industrial Disputes Act. The Industrial Disputes Act has given how to calculate the retrenchment compensation. 15 days salary, average salary for every completed year of service or a part thereof in excess of 6 months. So 15 days salary for every completed year of service or a part thereof in excess of 6 months. Then fixed amount of 5 lakh. The least of these three will be exempted, remaining is taxable for retrenchment compensation. So in this video, I have explained you about the retirement benefits, tax provision regarding retirement benefits. That is gratuity, commuted pension, leave encashment, refund from SPF, RPF and retrenchment compensation. So the problems are based on this theory which I have explained. So if you have watched this theory with interest, with full seriousness, definitely you will not find any difficulty in solving the problem. Inshallah, we'll do the problem on these retirement benefits in the next video.